Hey guys, welcome to another episode with me, Shashank Udupa. And in today's episode, we're going to talk about what is better to invest. Do we invest in the Indian stock market or do we invest in the US stock market? Now, let me tell you something. There was this famous quote by Warren Buffett which said, never invest in a business that you cannot understand. So you might say, okay, you know what, I don't understand any US business, so should I actually invest? But people take different interpretations now, especially with India warming up to investment opportunities, especially outside India. So a lot of people are looking at outside India investments, or especially in United States. And we've seen all this happening with Tesla and Google and all these FANG companies. There are others who would say, you know what, no. India is the best and we should not consider investing in US. So today I'm going to check what is better. We're going to do a correlation difference. We're going to find what is better. Is US stock market better or is the Indian stock market better? And we're going to compare these two. Now to take this with comparison, I'm going to take from the US side, I'm going to take the Dow Jones Industrial Average Index, which is DJI, as a proxy. And for the Indian markets, I'm going to use BSE Sensex. Again, I'm going to back all of this with data and stats because I just don't want to come here and tell you stuff without data and facts. Okay, so let's begin the first way to differentiate between the two. Now, the first point we're going to measure is correlation and portfolio diversification. Now, what is correlation? Correlation is basically a measure of the mutual relationship between two variables. So, we have the DJI and the BSE Sensex, and how do they correlate with each other? Are they moving together or are they moving in opposite directions? We're going to find out. Now, after we compared the monthly returns of the last 10 years of the two indices and computed, we got a correlation coefficient of around 0.54. This basically indicates that there is a semi-strong relationship between the two markets, and hence any diversification strategy must be handled with caution because both of them are slightly related to each other. Okay. Now, what's interesting about the US market or the US stocks is basically that you not only get the exposure of US but also to the world, because there are so many companies that are global companies operating out of China but are listed in United States. So you can actually invest in these US stocks, but they're not homegrown US stocks. They're actually stocks across the world. So that is very important. The second thing that I want to look at is the currency element over here. Now, if you take the Indian rupee, which basically we have witnessed now that Indian rupee is consistently falling with respect to the American dollar. Now, this is a major con for Indian investments because all investments made in Indian markets are in INR. So slowly we're seeing a decline over time. But in this year alone, the dollar is up by 6% against the rupee. Now, one of the major advantages of investing in the US market is the American dollar. It basically appreciates in value. So your investment also appreciates in value if your portfolio remains unchanged. So if you just keep your portfolio just like that without moving, you've already made approximately 6% gains, right? But if your portfolio also goes up, then even great for you. Now, the third parameter to look at is volatility. How volatile is this market? Now, a lot of long-term investors don't care about volatility because they're like, you know what, I'm here for a very long period of time. So these short-term spikes, ups and downs, I don't care too much about it. And especially when you're investing in, say, for example, the US market and the Indian market, you want to be there for a long period of time. So you don't care about the short-term volatility, right? So basically, you can consider volatility as a measure of risk. That's all it is, right? Volatility is a measure of risk. Now, if we take a look at the last 10-year returns, and we calculate the volatility of all this, the Dow Jones index was 3.92%, whereas Sensex was considerably more volatile at 5.06% only in the last 10 years. So basically, Sensex has been very volatile and Dow Jones has been slightly less volatile. Now, it can be inferred that in the last 10 years, the Indian markets have been slightly more riskier while giving the same returns as the US market. Okay, understood? Indian markets have given almost the same returns as US markets, but Indian markets were slightly more volatile and slightly more riskier. Okay, and US markets have been less volatile in the long run. Now, if you look at Indian markets, Indian equities basically have shown greater volatility and also bigger swings in returns over the last period. It's not constant, it's like this, right? So this is something that we have observed, whereas US market consistently gives returns. But again, next, I want to look at performance. Who is better than whom, right? So I'm going to look at performance next. Now, if you talk about performance, in the last 10 years, who's given whom what returns, right? Both the US and the Indian stock market have generated similar returns for investors. Now, the DJI, okay, the Dow Jones Index, has basically given a compounded annual growth rate of 9.75%, and Sensex has given a growth rate of 9.7%. Right, 0.05% difference in the last 10 years. Now, the returns in the first 5 years of this decade, which is 2011 to 2015, were also very similar, with US giving a 12.86 compounded annual growth rate, whereas Indian companies gave approximately, Indian markets basically gave a 12.11% compounded annually. So from a performance standpoint, both of them are here. Exactly here. But from a volatility standpoint, Sensex is more volatile, whereas US markets are not that volatile. Now, another parameter that everyone loves here, which is the valuations. Now, let's look at who's valued at what. Now, the Dow Jones Industrial Average has a P ratio of 16, whereas Sensex has a P ratio of 33. Now, everyone in the chat will be like, you know what, Shashank, 33, overvalued. Sensex is overvalued right now. Wait, first of all, just because Sensex is at 33 P ratio does not mean that the Indian market is overvalued and you should only invest in the US markets. First, let's get that straight. It essentially means that the market believes that the earnings of Indian companies will grow faster than US companies, and that is why they're placing a premium on the Indian companies. Now, if you look at the past, Indian GDP has also grown faster than the US GDP in the recent years. Now, that might also be the case why people are betting more on India than on US. If you look at the last 10 years as well, profit after tax or PAT of Indian companies in the index grew by 12.6% compounded against US, where they're growing at 11% compounded interest. So again, India looks like a slightly higher premium. So now obviously the P ratio is slightly higher for India. Is it overvalued or not? Can't say exactly, right? Now, even Indian governments allow monopoly in business. So stocks and companies with monopoly have outperformed US index, as no monopoly business is allowed in USA, right? So India allows it. So we can see slightly better performance from Indian companies from that perspective. The next thing we look at is size. Okay, how big is the Dow Jones index or how big is Sensex? Now, if you look at the combined market capitalization, okay, of all stocks you combine, the Dow Jones basically amounts to $8.33 trillion, nearly 8 times more than the combined market capitalization of all stocks in the BSE Sensex index, and we are at $1.16 trillion. So literally the US markets are 8 times bigger than us with respect to size, right? But given the size of the country, this shouldn't be a surprise, because obviously they are a developed country and we are still a developing country, but we are developing at a super fast pace. Annual returns show a very low correlation between the two markets. Now I'm talking about returns. Okay, so the price comparison over the last 10 years shows a correlation of only 0.36. So basically we can say that there is a low correlation in the market. Now low correlation is a major reason why Indian equity investors have to diversify abroad, and they want to start investing abroad as well. Okay, I'm going to show you another graph where it shows that Dow Jones has comfortably beaten Sensex over 5 and 10-year time periods. Now, if you look at financials, okay, now we come to financials. Financials dominate Indian indices, okay? US market favors tech firms. So if you look at our industries right now, in India, a lot of people like financial companies, whereas in US market, it is slightly favored with tech companies. Now, US market exhibits comparatively a slightly even distribution across sector, whereas India is slightly biased towards one sector. And if you look at the US markets, people love FANG companies and tech-focused companies for the future. Whereas in India, if you look at the top 5 sectors, look at this graph. Top 5 sectors in the Sensex by index weight, 41 or 42% is just financials. So our entire index, which is our Sensex index, is moved by the financial industry. Whereas if you look at the Dow Jones, it is slightly diversified with infotech, industrials, financials, everything at a good amount, right? So we are slightly heavily focused on one side. Now, the frontline Indian index is more expensive than the US index. Now, Indian market continues to trade at a higher multiple and offers low dividend rate. Now, if I'm giving a higher multiple, that means it should give me high dividend rate, but it's slightly giving a low dividend rate, and you can see that in the image as well. Now, if you look at the image here, Sensex price earnings trailing dividend yield is 1.04, and if you look at the price to book value, if you look at Dow Jones index, they're giving a yield of 2.31%, which is slightly higher, right? Indian companies have also delivered higher earnings growth. Now, leading US firms have clocked lower profit growth as they have already reached a much larger scale of operations. So if you look at India, India is a land of opportunities. There are so many companies that are still small that are becoming big. Whereas in US, most of the companies have already reached a large scale, so their growth is not very big or not very great. So that is why India has delivered higher earnings growth potential. Coming to conclude everything, right? And I've shown you data of literally everything. Now, the global liquidity, as now we're seeing right now, the global liquidity infused by the US Fed, the stock indices have conquered new heights because of this strength, okay? So global events such as inflation, interest rates, Fed Reserve policies have to be considered when investing abroad. Now, growth rate across geographies have to be tracked as well. Currency movements affect these companies, margins, profitability, and the investor who is investing in these companies. So please be aware that currently, because of the liquidity that's in the market, everything's at an all-time high right now. But if you're investing abroad, there are different parameters you need to start tracking. So please get some knowledge on those factors. Now, for a growing number of Indian investors, US is fast becoming the first choice of global investing. So if I think about global investing, I'm only thinking about US. Now, from individual stocks, ETFs, we have so many different options when it comes to investing in US stock markets, even for beginners. Now, stocks and ETFs are not the only way to invest in the US stock market. You can also invest in international mutual funds that are available in India. And these mutual funds invest in US indices directly like the S&P 500. So you can look at that. Now, to know more about US market and the Indian stock market, subscribe to our channel, which is Grow Channel, and let us know in the comments what are your perspective regarding US versus India. What do you feel is better and where do you want to invest? Again, we'll keep putting a lot of educational videos like this, so I hope you guys like this video. If you did that, please click on the like button, share it with your friends, and subscribe to the channel. And I'll keep coming and keep giving you such amazing information always. Again, this is me, Shashank Udappa, signing off. And by the way, guys, just a disclaimer, I want to tell you that all the videos are only for educational purposes and should not be treated as any kind of buy or sell recommendations. Okay, so take care. See you later. Bye.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.